So today we're back on Cashed In, and we want to start at the beginning with buying a home with what's called an FHA loan. And what better to start than with the basics. So Michael and I have both purchased a property using an FHA loan, and we kind of want to dive into what that exactly means in terms of how much cash you need to put down, how much cash you can negotiate towards your closing costs, and things of that nature. So should we start with our personal experiences or the actual percentages down and things like that?
Yeah, so I'll run through, my own personal experience with that. I think that once I was getting ready to go to the start line, it's where am I going to come up with the money, to be able to put down, on this property. I had just started my career. I didn't have a ton of money, right? And I heard about this FHA product where I could put 3.5% down on a property. Yeah. Okay. And what I found is that I could put down 3.5%. There were stricter guidelines, more stringent guidelines compared to conventional financing
on the property.
On the property.
Yeah.
Right. So there was more stringent guidelines. Okay. So like for example, the paint couldn't be peeling. The handrails had to be at a certain height. They do
a GFCI on your water source.
Correct. Yeah. Correct. So they did a pre-inspection beforehand. So once I was approved for that, again, I think that most of it's market driven. Whether you're buying your first house for yourself, or it's an investment property, it has to be market driven, because for those of you that don't know, FHA, you're only allowed one, as I said in the last episode. Okay, and part of that is that you're required to pay mortgage insurance for anything under 20% down. The key with FHA though is that mortgage insurance never goes away, even once you get past 80% loan to value. Okay, you would have to then refinance out of that loan product into conventional financing. Whereas if you had a regular conventional loan, you're now going to be, the mortgage insurance automatically wipes clean. So I think that the key now is that you could house hack with FHA, right?
Yeah, totally. If we want to be specific too, if we want to talk numbers.
Sure.
So for basic math purposes, we'll use the figure $100,000, which depending on where you're at in this world, you could buy a house for $100,000. Okay. Sure. 3.5% down is $3,500, and you can buy a house.
Correct.
Granted, to buy the house, you have to pay for closing costs, like anything, right, and that might be $6,000, depending on your transfer tax, your prorated taxes. This is all jurisdiction based. So the cool thing with FHA is you can also negotiate with the seller to pay your closing costs, or at least a portion of it. So if you have the 3.5% down, $3,500, which can't be negotiated by the seller.
Correct.
You're on the hook for that. You have to have some skin in the game with FHA. It's only 3.5%. With your closing costs, however, you can negotiate up to 6% of the
family, yes,
of the purchase price to go towards your closing costs. So you have 3.5% down. You can negotiate up to $6,000 from the seller to go towards your closing costs. So you might only be coming out of pocket to buy a house for $3,500. Some places that's a security deposit.
Right.
And your mortgage payment, at least with my experience, depending on rates and your financial profile, my first house was a $54,000 house in Newcastle.
Okay.
My mortgage payment is $430 a month.
Wow.
It was like and I live in a nice house in Neshannock Township.
Sure.
Regardless of that, with FHA, you only need a 660 credit score, so it's not like you even have to be in the 700s, and $3,500 down. So it's something that's realistic. It's sometimes buying a house is a foreign concept to some people, but when you put it in terms and you simplify it down to those pretty affordable numbers, it can actually you could become a homeowner sooner than you think.
100%.
Yeah.
And there's actually another hack that you could do, whether it's, let's say you're buying your first investment property, right?
Yeah.
Now, if you're doing it FHA, it has to be owner occupied. So that person, the landlord, yourself would have to claim residency there for 1 year.
Yeah. That's what I wanted to point out. So I'm glad you said that. Only 1 year.
Correct.
Yeah.
Correct. So, while you're in one of the units, let's say there's 3 units. Okay. You're in one of the units, you could start to fix up your unit a little bit. Say someone moves out, you could start to fix up the other unit, some fresh paint, flooring, and one by one, so that after that first year, you know, you might find yourself in a really, you know, nice equity position to the point that it's like, you know what, I'm gonna take this a step further. I'm gonna rent my apartment out after you refinance out of into conventional. I'm gonna go buy something else FHA.
Yeah.
I'm gonna buy another duplex.
Yeah.
Do the same thing. And there's actually a product out there through FHA. It's called an FHA 203K loan, which is the same amount of money down. There is some stringent guidelines around it, but you could actually pay and finance in the rehab costs.
Yeah. Oh, you need a 203K certified contractor to do
Correct.
the work.
Correct.
And FHA loans you the draw money to the contractor in increments, and they go through and you can finance renovations on a house, and they take an after repair, you know, appraisal value, making sure that you know, you're injecting the appropriate amount of money into it, and it's a viable piece of collateral. It's kind of insane to think about it. How cheap money is.
Money. Right.
You're using someone else's money. You need 3.5% down. I know I've said this 19 times by this point, but it's ridiculously affordable, and I don't think people are educated or even aware to know that could happen.
Right. Yeah. Right. And well, and let's talk about maybe the people that aren't renting out a house right now, you know, and they actually have their own primary residence right now, and they want to get into, you know, buying multifamily homes. Okay, so say for that individual, you know, they're both, you know, the husband and wife, you know, they're working full time, you know, they're saving money, they're saving some money, you know, but they don't quite have the amount of money. Maybe it's based on the market or whatnot to be able to put down on the property.
You're saying they don't have the 3.5% down.
They might not have the 3.5% down.
Okay,
but you know, they've been living in their house for the last 5-6 years, and they're in a really good equity position there. Yeah. I actually, and I could speak to this myself because I found myself in the same position. FHA, okay, I put a little bit of money into it. You know, the property I bought was in downtown Beaver, and I knew I was in an equity position from it because the person that had left, the house had previously sold for, I want to say, $40,000 more than what I had bought it for 2 years prior. So I did a little bit of the work to get it up to FHA code. And 2 years down the line, the market started to creep up in Beaver, and the house ended up appraising, where I bought it for $285, it appraised for $350. I was now eligible for a home equity line of credit. Okay, so what I did was I decided that I was going to now look for my next investment property and use that home equity line of credit and bought a second home to use as a short-term rental in Ocean City, Maryland.
You're talking about Iroquois?
It was Iroquois.
Yeah.
Correct.
Okay.
So I used that. So second home financing is 10% down. Mm-hmm. Okay, but I was able to still use somebody else's money to get that deal done.
Exactly.
I didn't have to come out of pocket with that.
No. And now you have an income-producing asset while you have an asset appreciating in value, using the money against it. Like it's like genius almost. It's ridiculous that these things exist.
And the thing with the home equity line of credit is that I think it takes discipline. It really does, because oftentimes people find themselves, you know, they have a $20,000, $25,000, $30,000 line of credit, you know, on their property, okay, that they're living in. Okay, I know that a lot of people like to save that as like a next nest egg. Over 30 years, I'm going to pay that. I'm going to pay my house off, you know, and then I'm going to be in this really good position, which is one way to do it.
I think it's a really old school way of thinking.
It is, you know, buy cash flow producing assets.
Yeah,
that is what's ultimately going to generate wealth. It's going to grow your cash flow position, and ultimately what's going to lead you to financial freedom.
I wish someone would argue with me and tell me why they wouldn't want to do that, because I can't comprehend on why they would just want to buy one asset and pay it off and not try to utilize it to buy another one. Because they're scared, you know. It comes down to the cash thing. It's like, I'm scared that what if the furnace goes? What if I need a new roof? You know, it's all about discipline, but you allot for those items as well. It's not a roof, you know, sometimes isn't always $20,000.
Right.
I know roofs on houses that are, you know, probably, let's say $150,000 for $8,000, you can get it replaced.
Correct.
There's tin style, like there's things that you can do that aren't going to cost you an arm and a leg, or you're not going to lose your shirt on this investment.
Well, and if you're looking at this comes down to the due diligence part of this. If you're looking in the right market, right, the right property with the right price and the right cash flow, having maintenance on a property, it comes with the territory.
Yeah.
But if you have the right cash flow and you're doing what you should be doing and setting a certain amount of money aside for reserves, right? Because those types of things happen.
Yeah, they do.
Furnaces go.
How many furnaces have gone on you at the same time?
Oh, I just replaced 3 within the last 6 months, and I don't even want to talk about hot water tanks.
Oh yeah.
You know.
Yeah. I can feel you on that. I only replaced one. My furnace blew up.
The furnace?
It combusted. So
Right.
I had to get a new one, but
Right.
not 3 at a time.
So
But it's doable is the point I was getting at.
It is. It is. So, we talked about, some of these other options that are there as it relates to buying the property. Okay, so you have the FHA. We talked about a couple different ways to come up with the money to be able to come down on that. What do you look for? What do you think are important features when you're looking for the right property? Well, how do you kind of go about analyzing that property?
In terms of FHA, like utilizing FHA,
in terms of market analysis and property analysis.
Okay, is this a good buy?
Is it a good buy?
Okay, well, 3 factors: location, condition, and the climate of our current market. That's how I value a property. So if it aligns with what the seller is asking, then okay, this could be an appropriate buy, or it could not.
Right.
So location, I mean, people have seen that billboard where it's like location, location, location. Like it's a real estate thing.
Right.
It is true. It is an indication, or how we quantify what value is to a property. Is it near, depending on what city you're in, is it near foot traffic? Is it near, can you catch a bus, a T-line? Is it near an industrial zoned area?
Sure.
Is it in the school I want to be in? Is it near, how far is my commute to work? Things like that. That's a location quantifier.
For sure.
And it could be per person. And then we use, what else did I say? Location, condition. Mm-hmm. Condition has it can be broke down into different factors too. So condition could be layout. Like, is my bedroom on the 2nd floor and I have to walk downstairs to take a shower? Right. Sometimes that's awkward. Right. That in a layout or an efficiency score would be low.
Yeah, it actually brings me into my first duplex I bought. The bathroom, there was a vanity and a shower in one of the rooms, and then up the hall there was actually a random toilet and a sink.
Yeah, it's like people that like hodgepodge houses together. Pittsburgh is known for its basement potty. Like the Pittsburgh potty is a toilet. For people who are not from Pittsburgh, it's a toilet in the middle of a basement with no wall around you.
No wall.
It's just a toilet. It's just you just use the toilet in the middle of a huge old room.
Yeah.
I don't know why they did that. I'm not even gonna guess. But to me, that's like a low efficiency for a layout. It's like a low quality score for a layout.
Right.
People just leave it there for decoration, like an homage to history. But nobody really uses their basement toilet anymore that I know of. If you do, no judgment. I think it's weird. Yeah. But anyway, so I just sold a house where. And it's sold for premium. The layout for the laundry was you walked down the basement and the washer was here, and you had to walk down, make a left, and go behind it for the dryer. It was the goofiest thing.
Yeah.
I've seen 2 toilets, now that I'm thinking, in one bathroom. That was also odd. I have a picture of that.
You do?
Yeah, that's strange. And they both functioned. Both toilets were hooked up to water, and I don't know. I didn't understand, but being an agent, like that's where you get some humor relief because some people are goofy. Anyway, but
it is. That's a whole other topic. The tours that we've been on in some of the houses and the weird thing. I don't want to start.
The people,
and
the bugs.
Yeah.
You brought me to some shit. But anyway, I'm a trooper and I've walked through. Anyway, so that yes, layout is an indicator of value. And then the last one is location, condition, the climate of the market. So you just need to have a gauge of the current market. Like, are we in a seller's market? Are we in a buyer's market? What are interest rates? Are we stable? And if you don't know how to gauge that, then you need to call on someone who's in the market every day, such as an agent, a broker, an appraiser, things like that. Right. Which FHA has the appraisal contingency clause built into the agreement. So if you think it's a good idea and the bank doesn't think so, you're going to be protected by that clause.
Right.
Meaning, you put 3.5% down. Okay, this purchase price is $100,000. The bank comes in and says it's only worth $80,000. Now you're at a crossroads with the seller. You're protected because it's contingent on the appraisal. But I've seen it happen where the seller has conceded and said, "Okay, we'll sell it for $80,000," and I've seen it where the seller said, "No, kick rocks," and it terminates.
It just happened to me in Ocean City.
Exactly. Yeah. It wasn't FHA, but
it wasn't FHA. It was conventional second home loan.
Yeah.
It underappraised by $56,000, and they thought that the value was there. Truthfully, I thought the value was there as well.
Yeah.
But
Okay.
If the lender doesn't.
Side note: appraisers are wild people. Like I think I mentioned this last time.
Yeah.
Appraisers are wild, and there's a line if you look on your appraiser report. It's like at the discretion of the appraiser, because it's such gray waters. There's like really no like standard almost. There's kind of a standard, but the market changes every day because something could close, something could come on the market. So an appraisal is only good for one day.
Yeah.
Because the market is so volatile.
Yes.
And but anyway, so is it a good buy? You know, there's a sales comparison approach. We take those three factors: location, condition, and markets, and we compare it to what has sold similar to the house, to the subject property that you are looking at. That's how I determine if it's a good buy or not. Okay. It sounds like it takes a long time, but it takes me like
those are all
minutes.
those are the things that I typically look for as well. You know, I want to see, is the business district thriving? You know, is there any news? I know the Bellevue deal, which I'm sure, you know, at some point we'll talk about that deal, why I bought in Bellevue. You know, I know there's upwards of $500 million project that's going to be put in right before the Rivers Casino, right off the Ohio River Boulevard.
Yeah.
So when you see some of those types of things, and you see the markets continue to start to thrive and turn, it's probably a good time to buy.
There are broader quantifiers. Like,
Correct.
What's the economic catalyst that's going on? Is something shutting down? Is something coming to the market? Those are economic or market factors that play into your home's value, believe it or not. Like the cracker plant.
That's exactly why. That's one of the reasons why I actually got into real estate, was because I knew that Shell was putting this cracker plant in over in Monaca, and I thought actually the duplex on Lime Street, the one that we bought, it's right directly facing the plant. And, you know, I have 30 units, and I'd say over half are being rented by Shell workers. Still, you know, now it's winding down over the next year, but, you know, I thought, you know, look, these guys are getting per diem. They want these month-to-month leases, so you could really maximize the cash flow. And so to piggyback on what you were saying about how you're actually analyzing a property, for me, it's all of those things, you know, economic factors, but also, you know, the market rents, you know, and where they're at in that current property, what I think I could get, you know, and then also what my cash on cash return is, you know, and a lot of these books and a lot of things that you'll read online, they talk about the cap rate, which, you know, really what you're going to be doing in that, for those of you that don't know, you're going to just divide. It's a simple equation. You're dividing the net operating income by the value of the property.
Yeah.
Okay. So if you're somewhere around 10%, it's probably a good property.
Oh, that's like rule of thumb. Is like, can you find me a 10% cap rate? I'm like, I'll try, but it's not.
Well, and for me, I don't actually buy into that as much, because
it's a cash on cash return for me. Like, it's how long until I'm whole for my initial investment. You know, people like to say cap rate because I think it's just like a sexy term.
It's fancy,
but it's like, okay, how long am I going to be whole? Is it going to be 10 months? Is it 2 years? Like, normally my cash on cash return, you know, in markets prior to this one, because it's so unique, was 2.5 years. I was made whole on my initial cash investment, and that's when I bought another one. Now you're able to expedite that, and you're able to buy like multiple properties in a year.
Right.
So.
Right. Yeah. I usually tell people, when people ask me, what is a good return? How do I know, you know, if it's worth this price? Now, it's going to depend. You know, in the last episode,
compared to the S&P 500, you outperforming the S&P, then it's a good investment.
The floor for me really is about 30%, and that's the floor.
Yeah.
I you know, my properties are 35, 40, upwards of 50% cash on cash return, where in some of them I've actually been made whole within 1 year. Yeah. You know, based on that.
Airbnbs,
right? Absolutely. The
that's
margins
crazy.
There, it is.
Yeah.
You know.
It's a beautiful thing. But getting back to FHA, so we're kind of like back on that. Yeah, so pretty much valuing it, sales comparison approach. You named the factors that you look into. Is there any other factor that you look into when valuing a property?
So again, the FHA loan, you know, if you're trying to house hack and you plan on buying a 3-unit and then you want to renovate it, you know, rent it out, refinance that property to get it out of FHA into conventional, so you could buy another FHA property. You know, it's going to really be dependent on the market, you know, and the comps, because as I had said, you could be in a Newcastle or in Beaver Falls, and quite frankly, you could put the money into the property, but you might never get to that 80% loan to value. It might take you 5 to 10 years to get to that, on top of the renovation, rehab upgrades that you put into the property. But if you're in a Bellevue, for example, and it's a thriving market, an up and coming market, you could buy something 3.5% down, do some of that cosmetic work. You might find yourself not only at 80% loan to value, but with $100,000 in equity.
Yeah.
At that point.
Yeah. Yeah. You could definitely not do an FHA loan on the one you bought.
Correct. That's correct. Right. Yeah. I'd say there was just a little bit of peeling paint. On that
Oh
one.
my God. Or water flowing through
Water
the ceiling.
flowing through the ceiling or broken windows.
Or random
Yeah.
people living there.
Yeah.
That one was a trip. I can't wait to dive into that once we, build up to it. But that's when we can get into the fun stories.
Right.
Trying to think what else to talk about FHA with. If we covered all the bases.
Yeah, I think that the FHA, I would imagine most of the viewers that are going to be listening to us they're not looking to be first-time home buyers. They're probably looking to be first-time investment property buyers. Mm-hmm. So that's, I have a good friend in Newcastle that you actually sold him the house. That's the approach I think that is most beneficial for somebody that is, whether they're just dating someone and they're renting out a place, you can't be married and own a home and then go buy an FHA property. It's not going to work. They're going to pull your credit. They're going to see that you already have an existing mortgage, and that's going to.
It's actually beneficial to be unmarried.
It's beneficial to be unmarried and to not own a home, because if you're married, you're probably going to be, they're going to know that they're going to ask what your
Yeah, they take the lower of the two, right? And then you have to account for all of their debt as well.
It's kind of a gray area, truthfully.
Okay.
Where if you're married,
it's institution specific, so not all lenders are created equally either. I want to stress that point too, because other people, different lenders between, the biggest disparity will probably be retail and broker.
Correct.
But trying to decide on who to get a loan from. I always recommend a broker. I'm sorry, my retail, colleagues, but their service is premier compared to.
I totally agree.
I'm not going to say a name because I don't want to get sued, but any retail bank.
I've transitioned. The last couple of years, I've transitioned.
They don't need customers. Retail banks do not need customers, so they lack a customer service. If they don't want to work after 5 p.m., they're not going to answer your phone call. On the weekends, the holidays, they're not going to answer your phone call, and that's when deals are made.
It is, it really is, and I was going that approach, with more of the bigger banks, but they're really strapped. They can't really do a ton, in terms of that. They really follow those guidelines set forth to them from the Dodd-Frank Act, quite frankly, after the housing market crash back in 2008. Mm-hmm. So Dodd-Frank was passed in 2010, and the guidelines got a little bit more stricter as it relates to especially investment properties. So if you go through a broker, they're really able to
shop around.
You're able to shop around. You're able to get the best rate, the best costs associated to that,
service
tied to that. Yes.
Yeah.
I totally agree.
Yeah, it's. I'm wondering too. I know there's this talk rumbling, and this is straying away from FHA, but about second home loans, and we've talked about this.
Correct.
Like after March, they're enacting either is it a rate increase or is it going to be stricter guidelines when borrowing for a second home?
It's just a rate increase. It essentially what it says is that it's equivalent to I believe 1.25%, increase, and it's for single family as well as condos. Because I know in the Ocean City market, most of those properties that are over there are all condos. Okay, so I would have been kind of grandfathered into that since I would have went under contract prior to it changing. But here's the thing: when it comes to this, if your strategy is second home financing, and you want to do a short-term Airbnb, the margins, put it this way, if a point is going to deter you from buying that property, it's probably not the right property,
you're
and you're
not
not
ready for it, because sometimes you have to pay more to make more, if that makes sense.
For sure.
Just to get the opportunity, you might have to pay more up front.
You have to buy access.
You have to buy access. That's a great way to put it. It's kind of like with me. Like I don't, the way I do my taxes, I wouldn't qualify for a second home loan at the 10%.
Right, because those are Fannie Mae products. Right.
I would have to, it's a 15%. I mean, and when you're dealing with those priced homes, can be a lot of money up front. Mm-hmm. But I'm buying my access. I'll make it up in the back end.
Right.
You know what I can't be deterred by that extra, equity down, essentially.
Right. And that gets into, kind of those non-qualified mortgages, those bank statement loans.
Yeah.
For anyone that owns their own business. Okay, that or you do real estate investing full time. You don't want to. You want the write-offs. You don't want to pay Uncle Sam, out of your pocketbook, to be able to
probably give it to me.
Right, exactly. I'll know what to do. I know what to do with it better than the government. I promise you that.
Especially those bridges.
What's that?
Said the bridge that just fell.
The bridge.
Well, where's the money going?
Right.
We're not going to get. That's a different podcast.
That's a different one.
Yeah. Anyways, sorry, you were on a good tangent. Go ahead.
Yeah, no. So these loan products that are out there, these bank statement loans, you know, I've transitioned away, you know, from I've transitioned away from the Fannie Mae and Freddie Mac loans because you could only have 10.
Yeah.
They really cap you at that 10 mark. You know, once you get 5, you know, it starts to get a little bit harder and harder to do. So I was at 10. And so I had to start to refinance these properties into these non-conforming loan products, which aren't backed by Fannie Mae. So I don't have to follow their guidelines,
Right.
which ultimately is going to allow me to show less rental income on my tax returns based off the write-offs and deductions that I have.
Absolutely.
And it's also going to allow me to continue to scale my portfolio while keeping more of my cash flow at the end of the year come tax time.
It really comes down to being aware and being educated of what you can utilize to save as much money as possible. You know, of course, we all have taxes in America. It's inevitable. But if you understand how to use, you know, the laws that are in place to kind of defer them or be able to keep more of your money to spend it somewhere else, that's where the actual, I feel, value comes from
Right.
being knowledgeable. And that's what I'm hoping to, or we're hoping to kind of give out on this podcast.
Right. You know, the tax code really, in my opinion, was made to benefit the top 1% the most.
Absolutely.
But the top 1%, that same tax code applies to you and I.
Yep.
Applies to the regular average blue collar worker.
Yeah.
It just depends on whether or not you want to take that leap of faith and
Yep.
believe in yourself and actually put that to work.
Yep, all comes down to mindset, like we talked about. But just to recap on what we spoke about just now is FHA. Difference between lenders: there's retail and there's broker, and the advantages and disadvantages of that. The advantage of FHA: 3.5% down, negotiate up to 6%, seller's assist. You only need a 660 credit score. You know, there's condition requirements with peeling paint, fire rated doors, things like that. Your agent can go over that with you, or you can Google it. It's a government website. You can see it. And debt to income ratio is 54%. I think is allowed, which is a lot. It's
higher for those than it is for
higher for FHA. So if you're looking to buy a house, I believe it's totally affordable. It's, you know, and Pennsylvania does something state specific where it's called a FHA loan, where they actually, based on your financial profile, can give you a down payment, a grant. So that is something you definitely want to Google and research. So if you can get the down payment from the state and then you can negotiate your closing costs, you can essentially buy a house with no money out of pocket. So
it's amazing.
Yeah, I think that was good. So, all right. Well, if you have any questions, make sure check our information below, reach out, direct message, and we can help you and answer any questions. So thanks for listening to Cashed In.